On October 10th, over $19 billion was liquidated from the crypto market, the single largest wipeout in history, turning portfolios into zero. However, does it mean that you cannot build wealth in the crypto market? The answer is no. If you've ever lost money trading crypto coins, don't beat yourself up. You're not alone. The truth is, most beginners jump into the market chasing FOMO and hype, forgetting to understand the market. They end up becoming the exit liquidity for smart money investors who dump on retailers. In today's video, I will reveal to you 3 powerful indicators that professional traders use to protect their capital and grow their crypto portfolio, even in the most volatile market. Let me tell you this. The ultimate goal of a smart trader is to protect their capital. Your capital is the most valuable asset you have in the market. Without it, you can't take advantage of new opportunities, you can't recover from losses, and you definitely can't grow wealth over time. Every professional trader knows this. The first rule of trading is not to make money, it's to avoid losing it. Because when you lose 50% of your capital, you don't need a 50% gain to break even, you need a 100% return. That's why smart traders always focus on risk management before profits. Before we go ahead, I want to let you know that this video is not financial advice. It is only for educational purposes. The crypto market is highly volatile and can wipe out your portfolio within minutes if you don't know what you are doing. Prices can swing wildly based on news, tweets, or even sudden market sentiment shifts. Unlike the stock market, where you can invest in ETFs, which are generally more stable and diversified, crypto carries much higher risk because it lacks the same level of regulation and long-term market maturity. And if you want to know more about ETFs, how they work, why they're safer for beginners, and how they can help you build wealth steadily over time, check out my video on ETFs. Remember, only invest what you can afford to lose. Don't invest your emergency fund or rent. The first powerful crypto indicator you should understand before diving into the market is candlestick reading. You might have seen candlesticks reading of different cryptos, but don't understand how it works. Let me tell you this. Each candlestick tells a story, a battle between buyers and sellers. Let's start with what candlesticks are. A candlestick is a visual representation of a cryptocurrency's price movement over a specific time period. It shows 4 key things: the opening price, closing price, highest price, and lowest price within a given time frame. For example, let's say we're looking at a 1-hour candlestick of Bitcoin. At 1 p.m., Bitcoin opened at $107,000. During that hour, it dropped to $106,500, the lowest point, and went as high as $108,000, the highest point. Finally, it closed at $107,800 at 2 p.m. Since it closed higher than it opened, $107,800 greater than $107,000, that candlestick will appear green, showing a price increase. If it had closed lower, for example at $106,500, it would appear red, showing a price decrease. These are called candlesticks, which tell you about the price movement of a cryptocurrency. Each candlestick shows the price movement of a particular time frame. For instance, this is a daily candlestick of Bitcoin price movement on October 10th, 2025. The body, which is the thick part, shows the range between the opening price for the day and the closing price for the day. The wicks, which are the thin lines above and below the body, show the highest and lowest prices that Bitcoin reached in the day. Like I said earlier, a red candlestick means that the closing price for the day was lower than the opening price, while a green candlestick means that the closing price for the day was higher than the opening price. Each candlestick is like a mini story of what happened in that time frame. Who was winning the battle? Buyers who are known as bulls or sellers who are known as bears. By learning to read these candles, you can see whether the market is confident, fearful, or uncertain. And that's how professional traders predict the next move. But here is the real secret. The shape of the candle matters more than the color. For example, the appearance of a Doji Candlestick could be a sign of a reversal signal. A reversal signal shows that the prior trend is about to change. Let me give you an example. Think of the crypto market like a car driving on a long road. When the market is going up, it's like your car is driving uphill. The price keeps rising. When the market is going down, It's like your car is rolling downhill. Prices are falling. Now, a trend reversal happens when that direction changes. The car stops going uphill and starts going downhill, or vice versa. Let's look at a few candlestick patterns that may indicate a potential reversal. The first one is the appearance of a hammer and hanging man pattern. A hammer is a candle with a small body with a long lower wick, which appears when the market is on a downtrend. It's often a sign that the market might bounce back soon. A downtrend means the market is consistently moving downward over time. Like, the Bitcoin price is falling. In contrast, an uptrend means the market, or price of a coin, stock, etc., is consistently moving upward over time. Like, the Bitcoin price is rising. The opposite of a hammer, which is the hanging man, is a candle with a small real body near the top and a long lower wick. It appears during a rally and signals that the prior trend is about to end. It is a sign that the bulls are losing the battle, and a correction might be imminent. In essence, the same candlestick can be bullish or bearish, depending on the appearance. What does bullish mean? Imagine Bitcoin is at $110,000, and traders believe it's going to rise to $115,000 soon. They start buying more, expecting profit. Their optimism pushes prices higher. That's a bullish market. However, what does bearish mean? Ethereum is trading at $4,000, but traders think it's going to drop to $3,500 soon. They start selling before the fall happens. This selling pressure causes the price to drop even faster. That's a bearish market. One way to confirm a hammer or hanging man candlestick is by looking at its shape. The real body, the thick part of the candle, should be small, and the lower wick should be at least twice as long as the body. Also, the real body should appear near the top of the trading range, showing that even though sellers pushed the price down, buyers managed to bring it back up before the candle closed. Remember, it is not compulsory that the lower wick should be at least twice as long as the real body, but the longer it is, the clearer the chart is. In some cases, the appearance of a hammer or hanging man can push the market into the consolidation phase. A consolidation phase happens when the price stops trending. It's not clearly going up or going down. Instead, it moves sideways within a tight range. At that point, the market is taking a break. Buyers and sellers are almost equal in strength, so the price keeps bouncing between support and resistance levels without any clear direction. Another way to identify a trend reversal is the appearance of a doji. A doji is a candle with a long wick at the top and bottom. In the case of a doji, both the opening price and the closing price are almost the same. It's telling you that buyers tried to push the price up, but sellers fought back hard. That's often a sign of weakness and a potential reversal. One of the ways to confirm a doji as a potential reversal signal is when it appears after a strong parabolic rally or a steep decline. When the market has been moving sharply in one direction and suddenly a doji forms, it's a warning sign that the current trend may be losing strength, and a possible reversal could be near. And the chances of a market reversal are further boosted if the candle that comes after confirms the doji's reversal potential. The doji is a very important candle if there are not many doji in the chart. There is also a doji star that forms when a doji appears slightly above the real body of the previous candle in a rising market, or below the real body in a falling market. That's why it's called a star, because it seems to hover away from the previous candle's body. This pattern is seen more often in the stock market, where price gaps are common due to fixed trading hours. However, in the crypto market, such gaps are rare because it trades 24/7, meaning prices move continuously without breaks. But even without a visible gap, traders still recognize a doji star pattern when a doji forms after a strong trend, signaling that momentum might be weakening and a reversal could follow. But, like I said earlier, it is important to confirm the trend shift before entering or exiting the market. While candlesticks help to identify potential reversal signals and market psychology, they work best when combined with other technical indicators. These indicators help confirm whether the price momentum truly supports what the candlestick pattern is suggesting, giving you a stronger, more reliable signal before you make a trading decision. There are also other candlestick patterns, like the engulfing pattern, where we have the bullish engulfing pattern and the bearish engulfing pattern. However, unlike the hammer and hanging man, the engulfing pattern combines two opposite candles to send a signal in the market. Another one is the shooting star and the upside-down hammer, which can be called an inverted hammer. Although not a major reversal pattern, but a shooting star appearing after a major rally could signal a potential bearish reversal. In the shooting star, it has a small real body near the bottom of the candle, a long upper wick that's at least twice the size of the body, and a little to no lower wick. For example, imagine a car speeding uphill, that's the uptrend. Suddenly, it reaches a point where it tries to go higher but loses strength, the engine sputters, and it starts rolling backward. That's exactly what the shooting star shows. Buyers pushed the price way up, the long upper wick, but sellers came in strong and pulled it back down before the candle closed, small body at the bottom. This shift shows weakening buying pressure and increasing selling pressure, a warning sign that the trend might reverse. The shooting star is a top reversal pattern that appears after a rally, while the upside-down hammer is a bottom reversal pattern. There are also other reversal patterns like the Harami pattern. Harami is a Japanese word for pregnant, and the pattern looks like a small candle inside a larger one. A bullish Harami candle appears in a downtrend. The first candle is a large red one, and the next is a small green candle that fits inside the previous body. It shows that selling pressure is fading, and a bullish reversal might happen soon. For example, Bitcoin drops for days. Then, one small green candle forms inside the previous day's large red candle. A hint, buyers are stepping back in. A bearish Harami candle appears in an uptrend. The first candle is a large green one, followed by a small red candle inside it. It suggests that buying strength is slowing, and sellers may take over. Another reversal signal I will look into is the Tweezer Top and Tweezer Bottom. In the Tweezer Top, two or more candles with matching highs appear at the top of an uptrend. Think of it like the market hitting a ceiling twice but failing to break through. For instance, Ethereum tries twice to break through the $4,000 mark, but both times closes lower, forming a double top wick. It shows that buying pressure is weak and sellers may soon take control. In the Tweezer Bottom, two or more candles with matching lows appear at the bottom of a downtrend. This shows that buyers are defending a price level, and a bounce upward could happen. For instance, BTC drops to $110,000 price level 2 days in a row. Both candles have long lower wicks, a sign of strong buying support. Another candlestick indicator is the dark cloud cover, a bearish reversal pattern seen after an uptrend. It consists of two candles. A large green candle showing strong buying, followed by a red candle that opens above the previous close, but closes below the midpoint of the green candle. It's called dark cloud cover because it's like a dark cloud overshadowing sunny skies. The bulls are losing control. For instance, BNB is on a parabolic rally, and then all of a sudden, the daily chart shows the price hitting a record high of $950. But while the bulls are waiting for a break above $1,000, the BNB price drops and closes around $920, halfway into the previous green candle. That's a dark cloud cover, signaling a potential downturn. This pattern suggests that buyers tried to push prices higher, but were overpowered by sellers, showing that bullish momentum is fading, and a possible trend reversal could be on the way. The opposite of dark cloud cover is the piercing pattern, a bullish reversal pattern appearing after a downtrend. It also has two candles. A large red candle, followed by a green candle that opens below the previous close but closes above the midpoint of the red candle. It shows that sellers tried to push prices down, but buyers came back strong halfway through the battle. For instance, after several days of continuous dips, Ethereum opens at $2,810, which is lower than the previous day's close of $2,900. However, before the end of the day, the price rallies and closes at 3,050s, which is above the midpoint of the previous red candle. That's a piercing pattern, suggesting a potential upward reversal as buyers start to regain control from the sellers. There are also other candlestick patterns you can learn and understand how the market works. Remember, smart traders don't guess. They read these candle formations like a language. Because every wick reflects emotion, fear, greed, hesitation, and that's what moves the market. So, if you're entering the market for the first time and your goal is day trading, it's crucial that you take time to study candlestick patterns before buying any coin. It will save you the pain of jumping into trades blindly and losing money due to emotional decisions. By understanding how candlesticks tell the story of buyer and seller pressure, you'll start to see what's really happening behind each price movement, when to enter, when to stay out, and when to take profit. Remember, the market rewards patience and knowledge, not speed. Every successful trader you see today once spent hours studying charts before making their first smart trade. So learn first, trade second. Always remember, charts don't lie. They show the truth of the market. Every fear, every hope, every decision, all captured in price movement. Now that you understand how candlesticks tell stories, let's connect them to support and resistance levels, two of the most important concepts in trading, before we move over to the next indicator. Support is like the floor of the market, a price level where buying pressure tends to be strong enough to stop the price from falling further, while resistance is like the ceiling, a price level where selling pressure becomes strong enough to stop prices from rising. When you draw trend lines along these levels, you begin to see how the market respects certain zones again and again. The strength of a support or resistance line depends on three things. The first is the number of times the line has been successfully tested. This simply means that the more times the price bounces off a line, the more traders trust it. The second thing to note is the trading volume at each test. For instance, a strong volume near the line shows real buying or selling interest. The last point is the length of time the line has been in force. The longer the crypto coin's price fails to fall below a particular support level, or the longer it fails to break a certain resistance level, the more meaningful it becomes. Here's something interesting. Once price breaks below a support line, that same level often becomes a new resistance level. And when the price breaks above a resistance line, that level often becomes a new support level. This happens because traders remember those price zones. What was once a strong floor becomes a ceiling, and vice versa. Now, when candlesticks drop to a support line and bounce back upward, it signals buyers stepping in with strength. But if candlesticks struggle to break above a resistance line, it shows sellers are defending that area. Sometimes the appearance of reversal signals, like a hammer, shooting star, or doji, right at these key levels can serve as an early warning that the trend might shift soon. As a smart trader, always set a stop loss just below your support level if you're buying, or just above your resistance if you're selling. This protects your capital if the market breaks through your key level unexpectedly. There are scenarios where a previous support level becomes a strong resistance level that takes weeks to break, trapping novice traders in a losing position if they don't exit the market on time. Remember, the ultimate goal of a smart trader is to protect their capital. Now that you understand price action through candlesticks, let's talk about momentum, and that's where the Relative Strength Index, or RSI, comes in. Another powerful crypto indicator that helps traders measure the strength and speed of price movements. RSI measures how strong or weak a price move is. It ranges from 0 to 100, and it helps you spot when a coin is overbought or oversold. When RSI is above 70, the asset might be overbought, meaning it's been pumped too high, too fast, and could soon correct. When RSI is below 30, it's considered oversold, meaning panic might have pushed the price too low, and a rebound could be near. For example, imagine Bitcoin's RSI is 85. That means people are FOMO buying. At that point, smart traders don't buy, they wait. But if the RSI dips to around 25, that's when the crowd is fearful, and that's when smart investors start paying attention. But here's an important note. RSI shouldn't be used alone. If RSI says oversold, but candlesticks show strong downward momentum, it might still fall further. That's why smart traders use confirmation. They wait for the RSI to bounce upward, or for a strong bullish candle to form before entering. Another thing to watch out for is divergence. For example, if price makes a new low, but RSI makes a higher low, that's called bullish divergence, a strong signal that the trend might reverse upward. For example, on January 9, 2025, Bitcoin's price hit a new low of $91,203, with the RSI at 42 on the daily time frame. On January 13th, a new low price for the move occurred, with Bitcoin price dropping to $89,256. But this time, the RSI was at 46. This was noticeably higher than the RSI value on January 9th. A new price low and a higher RSI level formed a bullish positive divergence. Besides the positive divergence, the hammer that appeared on January 11th and the doji on January 12th further proved that the bears had lost the battle and a bullish reversal was coming up. The market then went on to witness a massive rally. Let's look at another example and why you should combine candlestick patterns with other indicators. Looking at the Bitcoin chart on the daily time frame, you will notice that BTC made a new low on October 3rd, 2024 at $59,828 with RSI at 45. After a brief rally, BTC price made another low on October 10th, 2024 at $58,946. But this time, you will notice that the RSI dropped slightly to 44. But the doji star that appeared on the same day and the succeeding bullish engulfing pattern was a confirmation that the market was about to rally. This shows that candlestick is a complement to the RSI. Meanwhile, if price makes a new high, but RSI forms a lower high, that's bearish divergence, a warning that the market could drop soon. For example, on December 17, 2024, Bitcoin's price made a new high of $108,353, but the RSI failed to make a new high to correspond to Bitcoin's new high. Instead, the RSI formed a lower high at 69, a warning that the market could drop soon. The doji that appeared on the same day and the succeeding candlestick on December 18th further confirmed the bearish sentiment. When you master RSI, you stop trading emotionally. You start trading intelligently, because it helps you know when the market is overreacting and when patience can save you from losses. The next crucial indicator I will talk about is the moving averages, MA. This is one of the most popular tools used by traders and long-term investors alike. A moving average smooths out price data so you can clearly see the overall trend, whether it's going up, down, or sideways. Let's assume that Bitcoin's closing prices in the past 6 days are $112,000. $110,000, $113,000, $109,000, $108,000, $114,000. The 6-day moving average will be 112,000 plus 110,000 plus 113,000 plus 109,000 plus 108,000, 114,000 divided by 6. The formula is P1 plus P2 plus P3 plus P4 plus P5 plus P6 divided by N. The P1 to P6 is the closing price over the past 6 days. The N is the number of days. So as the price continues to move, the calculation is narrowed down to the recent price action. So that means the longer the moving average, the less impact any single price movement will have on it. On the other hand, the shorter the moving average, the more sensitive it becomes to quick price changes. That's why long-term moving averages, like the 100-day or 200-day MA, provide a clearer and more stable view of the overall market trend. They filter out short-term noise and show the bigger picture of where the market is really heading. Meanwhile, short-term moving averages, like the 6-day, 10-day, or 20-day, are great for spotting quick momentum shifts when the market is about to make a short, sharp move up or down. Smart traders often use both together: the short-term moving average for timing entries and exits, and the long-term one for confirming the main direction of the trend. For instance, imagine you're driving a car on a long road. The short-term moving average is like your speedometer. It reacts instantly. When you press the accelerator, the speedometer jumps immediately. When you slow down, it drops just as fast. This is like a 10-day or 20-day moving average, quick to respond to market movements, but also easily fooled by sudden bumps or dips. The long-term moving average, on the other hand, is like your GPS route tracker. It doesn't care about every small break or speed change. It focuses on the overall journey, your direction and destination. This is like a 100-day or 200-day moving average, slower to react, but it gives a more reliable picture of the true market trend. So when traders combine both, the short-term MA tells them what's happening right now, while the long-term MA shows where the trend is really heading. Moving averages aren't just lines on a chart. They're powerful tools that help traders identify trends and spot key price zones. A moving average can act as a support or resistance level, depending on where the price is. When the price stays above a moving average and closes above it, it often signals bullish strength, meaning buyers are in control. When the price drops below a moving average and closes below it, it may indicate bearish pressure, meaning sellers are taking over. These zones often behave like invisible floors and ceilings in the market. Moving averages help visualize these levels dynamically. They move with the price, unlike fixed support or resistance lines. Also, by watching the slope of the moving average, you can gauge momentum. If it's rising steadily, the trend is strong and bullish. If it flattens or starts to decline after rising, it may signal a weakening trend or an upcoming reversal. You can even draw trend lines on the moving average itself to track its slope and spot early signs of change. For example, think of the moving average as a curved guide rail that shows where the market tends to bounce or turn. When the market stays above the line, it's climbing with support. When it dips below, it's hitting resistance and might fall. Let's look at the two main types of moving averages. The simple moving average, SMA, calculates the average price over a certain number of periods, like 50 days or 200 days. The exponential moving average, EMA, gives more weight to recent prices, making it more responsive to the latest moves. So how do traders use them? One classic strategy is the golden cross and death cross. A golden cross happens when the 50-day moving average crosses above the 200-day average, signaling potential long-term bullish momentum. A death cross is the opposite, which is when the 50-day MA moves below the 200-day MA. This is often a bearish signal. For short-term traders, EMAs are gold. A rising 20-day EMA can act like a dynamic support line, meaning even when the price dips, it often bounces off it before moving higher. But once the price closes below it, that can signal a shift in momentum. As a trader, always have your own rule or pattern and stick to it. For example, some traders choose to sell a crypto coin or avoid trading it once the price drops below the 99-day SMA. Their reason is simple. A close below that level often signals bearish market sentiment. By following this rule consistently, they protect their capital and avoid emotional trading decisions. And remember this, when the price stays above a moving average, the trend is your friend. Don't fight it. When it breaks below, it's time to get cautious. Moving averages don't predict the future, but they give you clarity. They filter out the noise and help you stay on the right side of the trend. Now, think about this. You're analyzing a coin. The candlesticks show a hammer after a long downtrend. RSI is at 28 and slowly turning upward, and the price just crossed above the 20-day EMA. That's three confirmations: price action, momentum, and trend, all aligning. That's not gambling anymore. That's strategy. That's how you stop being a beginner and start thinking like a professional. You don't need to chase pumps or panic when the market dips. You just need to understand what the charts are saying. Before we wrap up, here's a quick bonus. Let's talk about one more powerful indicator, the MACD, Moving Average Convergence Divergence. This is the power of two moving averages. The MACD is one of the most popular indicators used by traders to spot trend direction, momentum, and potential entry or exit points. As the name suggests, it's built entirely on moving averages, specifically how they move together, converge, or move apart, diverge. Here is how it works. The MACD is made up of two main lines. The first line is the MACD line. This is the faster line, calculated by subtracting the 26-day EMA from the 12-day EMA. It shows the difference between short-term and long-term momentum. The second line is the signal line. This is the slower line, which is a 9-day EMA of the MACD line. It smooths out the movements and helps identify turning points. Now, what happens when the two lines cross each other? The crossovers between these two lines give traders signals about potential market moves. A bullish crossover occurs when the MACD line crosses above the signal line, which suggests that momentum is shifting upward. It's like the market's engine is accelerating, a potential buy signal. In contrast, a bearish crossover occurs when the MACD line crosses below the signal line, which indicates that downward momentum is increasing. Think of it like pressing the brakes, a potential sell signal. You might be wondering how this links to moving averages. Let me tell you this. The MACD is essentially a visual way to measure the relationship between two moving averages, the 12-day and 26-day EMAs. When those averages start moving closer together, the MACD lines also converge, meaning the trend is losing strength. When they move farther apart, the MACD lines diverge, showing that the trend is getting stronger. What this means is that the MACD line reflects the gap between short-term and long-term trends, while the signal line helps confirm whether that shift is temporary or sustainable. Like I have said countless times, never impose your opinion on the market. The market doesn't care what you think. It only reacts to price and volume. Always remember, charts don't lie. They reveal the truth of market behavior. The moment you start understanding the charts, you stop being a follower and start becoming an investor. And if you combine it with news, you gain the power to predict market reactions, not just react to them. That's where smart money is made. If you combine these technical indicators, you'll avoid emotional mistakes and save yourself from the big losses that wipe out beginners' portfolios. The crypto market rewards patience, not panic. It rewards discipline, not hype. So study these indicators, practice them, and let time and consistency do their magic. Remember, this is not financial advice. This video is only for educational purposes. The crypto market is highly volatile and can wipe out portfolios within minutes. So, don't invest your emergency fund or rent. Only invest what you can afford to lose. If there is anything you didn't understand and want a separate video on, drop it in the comments below. If you found this video helpful, hit the subscribe button below. Also, don't fail to like and share. Thank you.